A correction is defined as a sustained decline in the value of a market index or the stock price of a company. And while there is no universally accepted number, it is generally agreed that a 10% drop in value is considered a correction and a 20% drop is termed as a bear market. Now, for investors, stock market corrections can be very scary. And if we go with the 10% definition, then the Nifty 50 has seen 19 such corrections in the last 16 years. 2006, 2008, 2010, 2012, 2015, 16, definitely in 18, 2020, and of course this year, that is the year 2022. In fact, some years have seen multiple 10% dips, and if I have read you right, you weren't expecting the Indian stock markets to have seen 19 10% dips. But then what's also true is that historically, stock markets tend to recover within a few months of a steep correction. In that context, our research shows that the average Nifty correction is about 14%, and the correction lasts about 2 months before the upswing begins. Now, generally, this recovery is pretty swift, especially if the correction is on account of a political or external event, and more importantly, if it is not a bear market. Statistically speaking, the Nifty has faced 8 bear markets in the last 25 years, with one such event occurring every 3 years. The average time taken for the market to bottom is 8 months, with the longest time gap being as high as 20 months. The point I want to stress here is that corrections and bear markets are a regular part of investing. My first experience with a market correction happened on the 17th of May 2004 when the Sensex dropped by 16%, requiring the Bombay Stock Exchange to halt trading twice on that day. This fall was on account of a potential political crisis which really didn't pan out, and investors who saw that made a killing when the Sensex recovered most of the losses within the next 48 hours. I distinctively remember purchasing BEML for 100 rupees, which rose to 140 over the next 2 days. This bloodbath was my first lesson in investing on account of how fickle the stock markets can be and how corrections can be used to take advantage of. And so in this video, we shall look at some strategies retail investors can use to come on top of these situations. Let's begin. In the event of a correction or a bear market, a majority of investors get nervous and scared when faced with portfolio losses. The natural reaction to this is panic, and in the process, many investors sell most, if not all, their equity holdings. Historically, this act has turned out to be a huge mistake on almost every occasion, and here are a few tips that can help you curb that temptation. Tip 1 needs you to not look at stock prices too often. You see, when the major indices are tanking, it's pretty clear that most of your stocks will also be in the red, and checking their prices every hour will not really help you much. Instead, try and remember the investment thesis on the basis of which you bought that stock in the first place and see if those assumptions are still intact. If you're not sure how to build an investment thesis, then do check out our video on that topic, whose link I have attached to the description of this video. A second tip, which can be quite useful, is to remind oneself of your long-term financial goals. Like in my case, that 16% drop turned out to be nothing when I look at how the Sensex has performed in the last 2 decades. In fact, on the 17th of May 2004, the Sensex intraday low was 4,227 points, and exactly 18 years later, the Sensex was at over 52,000 points, thereby yielding a CAGR of 15% in spite of me ignoring dividends at this stage. A third strategy that I have borrowed from the Warren Buffett School of Investing is to keep some cash on hand for buying great businesses during these market dips. So do use some of these time-tested strategies, and please do not panic. There is enough empirical evidence that strong businesses generate a lot more wealth for investors when compared to mediocre businesses. And yet, when a market correction takes place, we see a lot more investors gravitating towards the weaker businesses under the hope that because they fell more than the stronger businesses, there's a lot more upside in these stocks. But the data we have doesn't support this, and therefore, in our opinion, and especially when there is a market correction, investors should aim to put their money in stronger, healthier businesses which are available at delicious valuations during these periods. In other words, you would do well to apply the classic Buffett and Munger doctrine of buying great businesses at good prices rather than buying cheap businesses. In addition to investing in these stocks, investors will need to show patience in riding out the prevailing uncertainty, which is absolutely necessary for wealth creation. Many investors invest in low quality stocks during bull runs and are often stuck with these when the market correction does happen. Now, when the dip comes, instead of holding on to these inefficient shares, one should explore getting rid of these stocks at a loss, and the resulting capital should be invested in high quality businesses which are now available at relatively cheaper valuations. And while we understand selling at a loss is a tough thing to do, maybe one can gain comfort over the fact that a whole bunch of taxes are available and money can be saved by setting off these losses against the gains you would have made on other securities. This is formally called tax loss harvesting, and if this term is new to you, then I suggest you watch our video on this subject, whose link is attached in the description of this video. A market correction serves as a wonderful opportunity to align your portfolio per your goals and risk tolerance levels. You see, what happens during a bull run is that your portfolio starts getting skewed towards equities, and very quickly your allocation starts moving away from your preferred 60-40 equity debt ratio to a more equity heavy allocation of say 75-25, which means there is a lot more risk in your portfolio. The other thing to consider here is that most of us invest in multiple asset classes. So we have domestic equities, debt instruments like PPF, EPF, debt funds, etc. Maybe we have some gold, international equities, and also real estate in our portfolio. And this allocation goes haywire when the markets suddenly spike up or when there is a sudden fall like what is happening now. It is thus highly recommended that you do a review of your asset allocation and rebalance your portfolio, as it not only reduces portfolio risk, but also ensures that you are less likely to make emotional investment decisions. From my own experience, I can say that a market correction is often when a first-time investor truly gets a sense of what risk tolerance is. People who cannot swallow the volatility often go slow or altogether quit investing in equities. But for people who go through this phase, they tend to have a better understanding of the importance of risk, asset allocation, rebalancing, and downside protection. In fact, if you find the time, I recommend you watch our videos on asset allocation and rebalancing. And if you want our help, then do explore subscribing to ET Money Genius, which offers 6 unique portfolios using time-tested asset allocation algorithms, dynamic rebalancing, better downside protection, and more importantly, Genius aims to achieve returns that are higher than its benchmark. Systematic investment plans or SIPs work on the principle that you accumulate more units when the markets are down, and as the markets rise, you are allocated a lesser number of units. This zigzag approach ensures that your acquisition price gets averaged over time, thereby creating wealth over the long run as the stock markets tend to rise over time. To illustrate the importance of a market correction when investing in an SIP, here's a quick simulation that we ran. So scenario 1 is the blue line, which denotes what is really happening in the stock markets. That is, the Nifty value keeps going up and down in bull and bear market cycles. And scenario 2 is the orange line, which is, let's say, a utopian world, a parallel universe where there is a perpetual stop loss and the stock markets never go down. Now, the data we have mapped here is over a 16-year period from the beginning of 2006 until the end of 2021. And if we run with a 10,000 rupee monthly SIP on the actual Nifty 50 TRI, we get an accumulation of over 59 lakhs in these 16 years at a CAGR of 14.3%. On the other hand, had we relied on our no downside imaginary index, we would have accumulated a lower corpus of 52 lakhs at a CAGR of 12.9%. So come to think of it, it's these corrections and bear market movements that have helped the investor collect more units in a mutual fund, which then translates to a higher wealth corpus over the long run. Of course, there will be some critics who will cherry pick certain periods that makes the averaging look horrible, but in my opinion, this strategy has and will continue to serve disciplined long-term investors to achieve their financial goals. Alright, so I said earlier that it takes an average of 8 months for the markets to bottom in the event of a bear market. But what might be of interest to us is in the understanding of the number of days the stock markets will take to get back to a new all-time high. For this, we refer to the data compiled by Gurjot Arora in his excellent Twitter thread, which shows that it takes an average of about 16 months for the markets to reach a new top. Understandably, an average can be all over the place, with the shortest climb to the top taking just 78 days in 1997, while it took over 5 years for the wounds of the 2008 global financial crisis to heal. But if you believe in medians and probabilities, then I would say we are looking at between 7 to 8 months for the economy to heal itself, although it's still anyone's guess. Nevertheless, the fact remains that corrections are a normal part of stock market movements, and you can make the most of them by deploying some of the strategies we discussed in this video. Further, if history were to be believed, stock market corrections are generally short-lived, so always consider that before taking any decisions which might have a long-term impact on your wealth generation initiatives. And with this, we come to the end of this video. I sincerely hope you learned something new today, and if yes, then do tap on to that like button, do subscribe to our channel and share this video with your friends. Thank you for your time, and I look forward to catching up with you next week. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.